to our market update webinar today with Squire Wealth Advisors. I'm Camille Fox, and a wealth advisor here within our team. I wanted to introduce you to a couple of our presenters here today. We have Brian Haywood. He is a certified investment management analyst. Brian takes pride in the time that he and his team spend customizing portfolios on behalf of Focus Partners wealth clients. Brian is also a member of the firm's investment policy committee, lending his insight on the firm's overall investment strategy. A passionate supporter of the Gateway Area Chapter and the National Multiple Sclerosis Society, Brian is a 7-time participant in the organization's Bike MS event, a long-distance cycling event that has raised more than $1 billion for the organization since 1980. He and his wife, Rachel, live with their daughter, Ella, in Afton, Missouri. For his education, he has received his bachelor's degree from St. Louis, Missouri, and was a retail sales assistant for UMB Brokerage Services, Inc. So that's Brian. Hi, Brian. And then we also have Sam Taylor here. So Sam has been with Focus Partners since 2022, and in his current role, Mr. Taylor assists with the maintenance and production of performance materials and other collateral that support Focus Partners investment solutions. He also supports the development and maintenance of portfolio modeling and analysis tools, empowering advisors to engage in more effective, client-focused conversations. Prior to his role, Mr. Taylor was completing his graduate studies in wealth and asset management. He holds a master's degree in finance from Washington University in St. Louis and a bachelor's degree from the University of Central Missouri. So appreciate you both joining us today. Let's get started. And I guess before we jump in, I do want to remind everyone that there is a Q&A as part of this meeting. So if you have any questions that come up throughout the meeting, feel free to click on that Q&A tab, type out any questions you may have, and we will address them for you. We want to make this as valuable to you and answer any questions you may have.
Great. Thank you so much. So Brian and I are going to tag team this presentation today, kind of give you kind of a background on this last quarter, and kind of give you kind of where we're at and where we're kind of expecting things to move forward. So with that, we'll get into the presentation. So the first thing we're going to kind of touch on is kind of the broader market, and this will kind of cement the entire presentation. Really in quarter one, we saw really 4 main themes, or at least 4 themes that kind of stood out to me. We saw AI stocks. So to end 2025, we saw AI valuations kind of sky high towards the top. To start 2026, we saw AI stocks kind of take a turn for the worse, kind of started underperforming. And really what the reason for that is the AI uncertainty. Investors were starting to kind of get shaky about the higher valuations. And so they kind of started to cycle out of those and maybe take some profits from AI stocks. So we started off the year to see underperformance with the AI stocks. The second theme we saw was international stocks outperform U.S. stocks. And this has kind of happened over the last year or so. But as you can see, year to date through 3/31/2026, we saw, although international stocks did underperform slightly, they were outperforming and ahead and fell less than U.S. stocks. And if you look at the 1 year, they are performing quite well relative to U.S. And I'll touch on that more later in the presentation, kind of dive deeper into that. The third theme that we kind of saw throughout the last quarter was value stocks outperforming growth stocks. So we've started to see a little bit of a trend to where value stocks are starting to kind of trend upward relative to growth stocks. A lot of that has to do with, that cycling out of AI, those large tech growth stocks into value stocks. But that's something that we're keeping an eye out as well. And then the last one, obviously, is the biggest one, which is the Iran war and kind of the geopolitical shocks that kind of shaped the market last quarter. As you can see, commodities did extremely well. So if you had some sort of exposure to commodities, you did very well. Mainly what drove that was obviously the rise in oil prices. And so, if moving forward, we're not sure what that's going to look like, but if you held it, you did pretty well this last quarter. So first, we're going to kind of chat about equities, and then we'll move on and talk about fixed income and then the economy. Taking a look at this graph, so essentially what this graph is saying is, the S&P 500, as I'm sure you all are aware, is market cap weighted. So they weight based on, the largest market cap. They'll put basically whatever the percentage is within the index. When you look at that with respect to the equal weight, so if you equal weighted all the stocks within the index, which will be called the average index, you're seeing the gap between them actually widen. And really what this graph kind of says is, you know, uh, a select concentrated few are really driving returns for the index. So as we see the spread kind of widen between the two, really what that's telling us is, only a few firms are really kind of driving those returns. We've seen over the last quarter that kind of come back and narrow a little bit, but it's still the same story. There's still an increasing concentration in those big AI tech stocks, and so we'll keep that in mind and kind of monitor that, as the year progresses and see how that kind of shakes out. As I alluded to earlier, we're starting to see kind of an international stock start to kind of perform well relative to U.S. stocks. And if we look at historically how this has looked, we actually see, through decades and decades of data, usually, these two asset classes are varying over time. And so one decade you'll have US outperformance and another you'll have international. And this is kind of just how it's always been. And so over the last decade, we've seen US stocks outperform. Over this, recently we've started to see sort of a trend in international stocks start to kind of outperform US and kind of, close that gap a little bit. So just to give you an idea of where we're at right now, current US price to earnings ratios, which is a metric we use to see how rich the US market is or stocks in general. The current US PE as of February 2026 is 30.17. So the historical average PE ratio for US stocks is roughly 17 and a half. So, I mean, that's a really big gap. So that's really telling us that US stocks right now are very, very rich compared to their historical average. Now, when we take a look at international stocks, what we see is a current PE of around 18.9. The historical average is roughly 16.3. So more in line value-wise with this historical average, kind of where we expect them to be on a relative basis. Now, when you compare the ratio, yeah.
Oh, Sam, I was just gonna jump in and see, based on those valuations where they're sitting right now, what does that kind of tell us about where we think returns are going to go in the future?
Right. So the current relative PE, the ratio between the two right now is roughly 1.6. The historical average is 1.09. So if we expect that to come down over time. We expect it to kind of mean revert over time. And so we should expect, and we're kind of seeing it now, international stocks, those valuations kind of increase relative to US. And so we expect that relative P ratio to come down and international stocks start to outperform. So the way it's looking now, international is doing great. I don't have a crystal ball. I can't tell you whether it'll continue, but it's looking good right now. So with that said, it's important to stay diversified. And so you're kind of playing in on both sides and you're kind of reaping the rewards of both sides. You're not getting too high or too low. You're right kind of in the middle. So it's good to have diversification.
That was one thing I was just going to add there as well. That's why when we do build our portfolios, we do like to have a healthy allocation of both United States and international. Like Sam mentioned, we don't have a crystal ball, but having that diversification and looking at some different metrics we have, like PE ratios, that gives us an indicator right now, like that United States stocks are expensive, that they do cost a lot for the same amount of earnings compared to international. And that is why we take a more diversified approach with allocations to both.
Exactly. Yeah. And that's the smart thing to do. I mean, we're, and I'm going on to this slide as well. I mean, it's the same story with growth and value as well. We're starting to see growth stocks get very rich and value stocks kind of, start to outperform growth stocks. And, these things happen, they vary over time. We've again seen it decades and decades of data where these sorts of risk exposures they kind of vary over time. So you never want to be all in one. You want to be diversified. You may tilt towards one or the other to, for example, we believe in a value premium. Um, but you never want to go all in on one single risk exposure because as you can see with the geopolitics, like that can really hurt at the end of the day. And so I'll touch on that, but yeah, it's important to stay diversified for sure. Um, and that kind of leads me to here, as we're seeing as well, we're seeing value kind of trend up. Just to give a relative PE, like we did with the U.S. International, the current ratio, so the growth PE over the value PE is roughly 2.68, and the historical average is 2.1. So we have seen the current relative PE kind of trend down towards that historical average, which is what we would expect over time. And so we are seeing value stocks start to kind of trend upward as well, just like international stocks, and start to outperform. Um, Again, we don't have a crystal ball. I don't know whether that's going to continue, but again, it's good to be diversified as much as possible.
One thing to remember looking at the screen, do you mind going back, Sam, to that?
Sure.
With both of these, and one thing to just remember is the long-term perspective. You can see with some of these visuals that there's multi-year periods that maybe one does look better than another, but this is why we do take a long approach with investments in general and looking at the long term. That yes, it's very normal to see certain areas of the market, whether it's from a country perspective or the style of the investments to maybe outperform. But this is again why we take a long-term approach and stay disciplined within a diversified strategy so that we're taking part in all areas of the market for growth.
Exactly. Exactly right. And kind of what's been on everyone's mind, at least over the last couple months, is kind of the Iran war and the geopolitics and how that's kind of reverberated around markets. Just to give a background on kind of like what happened during that time. So just a reminder, the Strait of Hormuz, which is a large exporter of, not itself, but a large channel of oil exports, and that was cut off during the Iran war. We are currently still in it. However, at the time, and we're still seeing it, oil prices skyrocketed, expected inflation increased. And so to compensate for that expected increase in expected inflation, nominal bond yields rose, which pushed bond prices down and as well as stocks. So that was why you saw a lot of volatility in the market. The market was pricing those in and kind of trying to make sense of what's happened. We've seen actually recently it kind of turned the tide. We've actually started to reach new highs in the market. And so that's kind of important to understand too. These things, these sort of shocks, these events happen. They happen more frequently than you would think. So this graph is really showing that, you know, for example, the Ukraine war or Liberation Day, so the tariff thing, that happens, and it's important to look at it in the broader overall picture of, markets will tend to correct themselves, and they tend to kind of look past these things and continue to perform. And if you look, the trend is still upward sloping. And that's important to look on at these things in a broader global picture, and to keep in mind that this is a long game, and it's important to stay diversified during these times to kind of lessen the impacts of these certain events. But yeah, I think this picture does a great job at showcasing that, stuff like this happens, and it's just important to keep in context the long horizon here.
Yeah, I think one other thing to mention here is, the importance of staying in your seat and how all these various events obviously do have an effect on markets, but markets tend to rebound pretty quickly after these types of things. If you would have gotten out, say after Liberation Day, you would have missed out on great returns kind of over the second half of 2025. If you would have gotten out after the market, corrected itself post the Iran war, you would have missed out on some incredible returns we've seen here so far in April. Really the market right now, as we sit today, as Sam mentioned, is trading at some of its all-time highs. So it's really kind of shaken off the effects of the Iran war pretty quickly. And I think what that is telling us is effectively the market is viewing the war as not over, but it seems like both sides are looking for an off ramp to hopefully end this conflict, and there won't be an expansion of this conflict moving forward. At least that's what the market is saying based on how it's performed over the past month or so. So the important thing is these things can't be timed. So it's important to always stay diversified, but also just stay in the market. The last thing we want to be doing is jumping in and out of markets based off of geopolitical events, because over the long term, that's going to cost a healthy amount of return.
I 100% agree.
I thought you
Thank you, Brian. No, I appreciate that. uh, and then, yeah, so as Brian alluded to, like these things happen more often than you would think. These market drawdowns, they happen all the time. So it's important, when these things happen. First of all, it's important to have a plan in place, and before. So have a diversified portfolio to protect against these certain shocks. Be broadly diversified, not just asset classes, but over different risk exposures. And so it's important to be, stick to your plan. Like you got to stay the course. These things happen, and it's just important to kind of keep that perspective in mind. But yeah, that is my kind of spiel on this presentation. I'm going to hand it over to Brian. He's going to talk about fixed income and the economy. So take it away, Brian.
All right. Thanks, Sam. If you want to flip to the next slide. Thank you. What we've got charted here is the U.S. Treasury curve. So the green line there at the top, that is where yields ended 2024. The purple line is where they ended 2025. And then the blue line is where they sat at the end of Q1. And what I can say is, looking at least as of yesterday, yields are basically at the exact same spot they were at as of 331. So I'd say today's yield curve is basically right where it was at the end of Q1. So what we've seen there is we've seen rates on, especially the shorter end, come down quite significantly over the past year to 15 months. And the reason for that is we've started to see, and I'll talk a little bit more about this, is we started to see an economy that appears to be slowing slightly. So the Fed has been a little bit more aggressive, especially kind of Q3 and Q4 of last year in terms of lowering the Fed funds target rate. And actually, Sam, if you want to flip forward to the next slide, we'll talk about the Fed. So as we sit today, the current Fed funds rate is at a range of 3.5 to 3.75%. We're actually going to get another. They're actually meeting today, and it might have actually come out already since we've been on this call, the most recent Fed decision. But everything was pointing to Chairman Powell and the rest of the committee leaving interest rates where they are at that 3.5 to 3.75%. I will say, looking forward, Fed policy is cloudy, to say the least. Obviously, there's still geopolitical concerns. The Iran war is still going on. Markets right now are pricing in the fact that it's unlikely to expand, but we don't know that. I would say if it continues to remain in this kind of stalemate and the Strait of Hormuz remains closed, we would continue to see oil prices continue to remain elevated, which would have obviously increased inflation here in the US. The way you can kind of think of that is when oil prices are high, that's effectively a tax on, an additional tax on consumers. So I would expect inflation to increase. Also, that would not be good for economic growth as you're taking money out of people's pockets. That's going to force them to maybe rein in other discretionary spending they might normally do. So obviously, that's going to have potentially some economic headwinds moving forward. As far as, oh, if you can go back, Sam, one slide.
My bad.
Right now, the Fed is expecting to lower interest rates according to their dot plot, 25 additional basis points this year. Looking at market expectations, they are not expecting any reduction in the Fed funds rate for the remainder of this year, and actually none really in 2027 until the very end of 2027, kind of a 25 basis point cut in December of 27. If policy wasn't already uncertain, we're also going to have a new Fed chairman. So this is actually Chairman Powell's last meeting as Fed president. Kevin Warsh has been nominated by President Trump to take over for Chairman Powell. So he is, from everything I've read, likely expected to be confirmed in the coming month or so. So we're going to have a new Fed chair. So obviously that could affect Fed policy moving forward, as each Fed chair likes to put kind of their own mark on the organization. So we'll see where things go. It's going to be interesting times ahead, given all the headwinds that are out there geopolitically and economically, alongside new leadership at the Fed. If we want to move forward. Now, moving into the economy. If you want to jump forward to the next slide, Sam. What I've charted here is the GDP growth rate over the quarter. So you can see, looking at 2025, we had actually negative GDP growth in Q1. And that was really a symptom of a large amount of importing in Q1. And the reason for that is the expectation was for Trump to increase tariffs, which he ended up doing. So there was a lot of companies that were importing way more than they normally would to try and get ahead of those tariffs. But you saw the economy in Q2 and Q3 expand pretty robustly, 3.8 and 4.4%. You can see in Q4 we only grew at a 0.7% clip. Now, I will say that is artificially low, although we did slow. If you remember, we had a massive 43-day government shutdown in Q4. And so that stripped away anywhere from 1 to 1.2% of GDP growth. That's kind of the estimate. So, really in Q4, we would say the economy grew probably 1.7, maybe 1.9%, somewhere in that general area. Looking ahead, according to the Atlanta Fed GDP number, we're looking at likely growth in Q1 of about 1.5%. So again, continued slowing. We'll actually get the first quarter number tomorrow, at least the first estimate. So we'll see how accurate that 1.5% estimate is. But from everything we're seeing here in the data, it looks to be we're seeing an economy that is beginning to slow a bit, but is still growing at a decent clip, but it definitely appears to be slowing. Sam, if you want to move forward. Now, the job market is telling a somewhat similar story. What we've charted here on the gray bars are monthly job growth, and then the blue line is the unemployment rate. So what we've seen, especially kind of the second half of 2025, is job growth has definitely slowed. It is still positive, the job growth is still growing, but it has definitely slowed from where it was in kind of 24 and 23. Fortunately, we haven't seen a big uptick in the unemployment rate. The unemployment rate has kind of been range bound around that, low to mid 4% area for about the past 2 to 3 years. So we really haven't seen an appreciable increase in the unemployment rate. I've heard a lot of people describe the economy as a low hire, low fire rate. So we haven't seen huge job growth, but we also haven't seen a lot of companies looking to, downsize their corporate workforce. I think this is really a symptom of a lot of economic uncertainty right now, whether it be, we still have a bit of uncertain tariff policy. Also, one thing I didn't mention earlier is the Supreme Court really gutted a lot of the Trump tariffs from last year, ruled a healthy amount of them were unconstitutional. So there's still a lot of uncertainty around tariff policy moving forward. Obviously, we have the geopolitical situation in the Middle East. We have a new Fed chair coming in, so the path of interest rates moving forward is very uncertain. So I think you just have a lot of companies that are kind of sitting on the sideline at this moment, kind of figuring out where things are going to go. And so they're not really looking to expand, but also they're not looking to downsize at this point. They're just kind of treading water, waiting for a more clear path for the economy to emerge. If we want to move to the next slide. I think this is a pretty good slide to indicate that. As you can see, coming out of COVID, what I've graphed here is the blue are job openings, and what the yellow line is the unemployment level. And so you can see, obviously, coming out of the pandemic, it was really a job seekers market. You had a ton of openings, but the unemployment level was quite low, and so you had a market that really favored job seekers. What we've seen, though, is we've definitely seen job openings decrease rather rapidly over the course of 22 and 23 to where we are now, where it's pretty much a 1-to-1 ratio between job seekers and job openings. So that kind of lends more credence to that low hire, low fire economy there, where corporations are, yes, when people leave, they're replacing them, but they're not really growing their workforce, but they're also not really downsizing it either. Sam, if you want to move to the next slide. Now, what we've charted here is moving on to inflation. And obviously, this probably would have been made a little bit more sense to talk about this around our Fed discussion, but what we've charted here is PCE inflation, personal consumption expenditures inflation. Where we've charted this versus CPI is this is the data point that the Fed typically uses to make decisions when it comes to inflation. And the reason they like PCE over CPI is CPI is a static basket and doesn't change based off of consumer choice. So obviously, when prices go up for certain items, consumers are going to change their behaviors and maybe transition to buying different goods or transition to using different services. And personal consumption expenditures captures those shifts in kind of consumer behavior. And so they view this as a little bit more robust measure of inflation for consumers. So what we've charted here is both the headline, which is the full basket of within the PCE index, and then the core, which strips away food and energy, which tend to be a little bit more volatile. So you can see headline PCE, at least as of January, was about 2.8%, and core was about 3.1%. So both of those remain above the Fed's long-term target of 2%. So The Fed's in a little bit of a difficult situation in that they have an economy that appears to be slowing slightly. Job growth also appears to be slowing, but you also still have inflation above their target. Not significantly above their target, but still above their target. So they have a delicate tightrope to walk because if they do lower the Fed funds target rate to try and stimulate the economy to get it going, that could put pressure on inflation to rise, or vice versa. If they keep or if they raise the interest rates to try and stave off inflation, that could further damage economic growth. So they're walking a very fine line, and I think they've actually done a fairly good job recently balancing those two risks. But it will be a delicate act moving forward, especially if we can continue to see oil prices high and which increases inflation while also being essentially a tax on consumer and potentially lowering economic growth moving forward.
Brian, while we're on this topic, we did get a question, and it may be helpful to go back to the other slide with the yield curve, but someone's asking where is the most attractive spot within the yield curve, considering everything that we've discussed today?
We would say, and this goes for not just today, but just in general, we tend to want to stay in kind of the short to intermediate portion of the curve. So when we say that, we're kind of thinking 10 years and shorter. And the reason for that is it's kind of the sweet spot between we're getting a healthy amount of the term premium, but we are also limiting our interest rate risk. For example, if we would looking at the yield curve today, hey, 10-year yields are around 4%, we could move out to 20 years and get closer to 5. But by doing that, you introduce a healthy amount of interest rate risk. So, for example, if the Fed would start raising interest rates and longer term rates would go up, those 20-year bonds would have a significant reduction in price. You'd see, the value of those bonds decline significantly. We don't need to look back too far to recognize what can happen there. If we think back to 2022, we effectively saw this where longer term bonds really got nailed when the Fed started raising interest rates to combat the higher inflation. Now, if you're asking me to choose one specific spot, I think somewhere probably around that 5 to 7 year is kind of the sweet spot right now where you're getting a pretty healthy return, but also not taking a ton of interest rate risk. And that's where we're generally positioning clients that are building fixed income ladders, kind of 7 year, 5 to 7 years and shorter.
Thank you. And also just as an update, like you mentioned, we did predict they were going to hold rates steady, and they did within the meeting. So I did want to confirm that.
Okay. Yeah, that looking at Fed funds futures, it was pretty much like 99.9% priced in. So it would have been trust me, we would have seen markets move if they did either. Well, I doubt they would have raised it, but if they would have lowered it, it definitely would have made news. So be interesting to see what Chairman Powell says in his press conference, given that this will be his final one as Fed chair. So I'll certainly, and the market will certainly be watching that press conference with bated breath.
For sure. So that was the only question we have in the chat. We'll stay on a few more minutes. If anyone does have any additional questions, please feel free to enter any there, and we can discuss that moving forward. Okay, well, I'm not seeing any other questions in the chat. If you do have any other follow-up questions, either specific to your own needs or anything from this presentation today, you can reach out to us here at Squire Wealth Advisors or your advisor. We're happy to discuss any of your needs or questions that are specifically tailored to your situation. So appreciate you all joining today and hope you all have a great rest of your week. Thank you, Brian and Sam.
Thank you.
Thank you.